Since inflation is up and it's really hard to get by on the wages people are currently making, I thought today would be a good day to dive into how investors use financing to build long-term wealth the smart way and maybe not the way that you have heard in your finance classes.
Yeah, and I think it's probably, good to just have some refreshers around good debt and bad debt,
Mm-hmm.
right? Yeah, those terms get thrown around a lot, and I think in its simplest form, um, you know, debt is actually good. But if you go to like on a Dave Ramsey or Susie Orman or some of these people and they say get out of debt, what they're really talking about is the people that don't understand it. And you're call it your W-2 person. But debt is a powerful leverage compound. It can compound for you. So bad debt would a great example of bad debt would be like a new car.
Mm-hmm.
Let's say $100,000 car where you put $5,000 down, $10,000 down, $20,000 down. You pick a number and you finance the other. Let's say let's call it $90,000. And it doesn't really even matter what the rate is. What's that car worth? Like, as they always say, when you drive it off the lot, it's worth a lot less. Okay, we know that. Okay, with some rare examples. Most of the time, when you drive a car off the lot brand new, that is what we would call a depreciating asset. Now, if you're going to hold on it for 10 years and pay it off, and who cares? Like, honestly, who cares? But if you're planning on rolling this car every 2 or 3 years, like a lot of people do, and they upgrade, or maybe even on a lease, you're always going to be behind the eight ball. That is a depreciating asset. Same thing with a brand new TV. The minute you buy that TV, it's worth. You're not going to sell it a year later, right? So those are depreciating assets. On the other side of that, appreciating assets would be things that other people pay off for you, using debt to put cash flow in your pocket, and so it's a very, very different thing to take a look at, right?
Yeah, because you can have a lot of debt, but as long as it's good debt, you're still in a good position. I mean, Ken has a lot of debt. I have a lot of debt, but it's more, what's your net worth after the debt, right? And so a car's not adding to your net worth. Buying a nice TV is not adding to your net worth. And a lot of people get stuck in this cycle of trying to prove they made it before they made it. And they get stuck in a bad debt cycle. And that is like the number one way to kill your chance of ever being wealthy.
And I think probably the easiest way to cut through all this is to say, who's paying it off?
Mm-hmm.
That's it. Is it you or is it someone else? And if you just draw the line there and say, I'm paying off all this debt personally, then you're probably a little bit more financially burdened than others. So in our case, when we're talking about debt, somebody else is paying it off.
The only caveat I would say to that would be your house, right? Like you're paying off your house, but I still think your house is good debt because it's going to appreciate and add to your net worth. I know my parents, when they retire, their house is their almost whole net worth, so I consider that a good form of good debt, as long as you have the money to pay it every month.
Yeah, that's true. If again, I'm really speaking more about on the investment side, but these two things do bleed over. But personally, like I have multiple cars, I have boats, I have jet skis. I have zero debt on those. Zero, right? I pay all cash for those kinds of, I would call them toys. And but when you start to talk about good debt versus bad debt, good debt is the bank is looking at the asset as the collateral. In the bad debt, the collateral is you. You know what I mean?
Well, I want to throw one at you. So student loans, good debt or bad debt?
It depends. And so, I hate that answer, by the way, but I'll just tell you why I think it depends. I know plenty of people that go into school and they rack up hundreds of thousands of dollars and they go into an industry where, the average pay is 30, 40, 50 grand. I would say that's bad. I also know those same kinds of scenarios where you might rack up that same amount and the starting pay is in the 100 to 200.
Mm-hmm.
So I think some of it has to do with that, right? Like, look at the end game. Like if you're going to spend a bunch of money on education, and by the way, this is not about education. This is about the payoff of whatever you're buying, right? It doesn't really matter. You can do an online course, and if the online course is cheap and you start to make a bunch of money, you crushed it. But if it's really expensive and you don't do a deal, then you have it. You know what I mean? So it's not really about a university at all. It's about the cost versus the payoff later. So that's why I say it depends. And so if you spend $100,000 on education or 4-year education, and I think that might even be low these days, the real question is if you pop out and you're an engineer or you're a doctor or you're a lawyer and you're a physician or something, then I think it could be worth it. But if I also know plenty of situations, like nurses and teachers and that are. And by the way, we need those people probably more than anything. But the payoff sucks, right?
Yeah, it really does depend on that. I know back in my day, everybody went to college and you could not even have a major. You could just go and graduate. You could be an English major. You could be a marketing major. I was a teacher. That ROI was terrible, So, you really do have to look at that in these times. If you have kids this age or you're this age of, is college really a good investment? Because as we've talked about in other shows, the debt will hold you back if you're not making the income, not only the payment, but the debt to income ratio you're going to have to be able to buy anything or, start investing in things. So you really have to pay attention to that.
And it's not really about the name brand of the school or the university or anything like that. It's literally about the education you get. Is it applicable and do I make money from it? That's actually how you have to look at everything. It's like a real estate license. You can go through school for that. So yes, it's much, much shorter time frame and it's a lot less money. The reality is, though, the payoff, if you're doing it like Danille did it, it's already paid for itself, right?
Correct.
That's the point.
Yep.
Right? Same thing with your esthetician license. Already paid for itself.
Yep.
So that's what I'm talking about. Does the degree pay for itself? And that's actually how you have to look at it, right?
Yeah.
My dad was a journeyman plumber, and the education, everything that paid for itself. The trade schools oftentimes pay for themselves, like especially on the HVAC, and some of those blue collar trades right now are crushing it. People are just crushing it, right? And so that's why the trades are doing extremely well right now. So the question is how many coders, how many graphic artists, how many content writers, how are they going to do now in this next generation? And is that $100,000 expense? What is it going to be? It's an investment. And so that's why I say I am 100% for education. But you also got to look at the bigger picture. So I would say go into debt for education if it has a good payoff, for sure. But if it doesn't, I would say no.
So let's talk about why investors don't need to start with money or they don't need to start rich. Because I, obviously did not use other people's money. I used my own. I saved it, and that is an option. But, Ken uses a lot of OPM, other people's money. And that could be in bank loans, private lenders, partnerships. You don't have to necessarily have the whole entire starting amount.
That's a good question. I think you got to start with how money works. So as people work their butts off and they get their paychecks, ACH or paper checks, if they even still do those anymore, it all goes into the banking system, let's say. And then there's always the life insurance person that pulls some away from you, and the wealth manager that, with the match program and or the pension or the 401k or whatever it is, the RSP for if the in Canada, or the superannuation if you're in Australia, or whatever it is, everybody's trying to take a piece of your paycheck. That system, all those things I mentioned, their business is to use your money to make money. I think that's a really important thing to understand. So as you make money, there's all these industries trying to take a piece of you. Okay, So where does all that go? If it all goes into the bank, then the bank's job is to lend it, right? Because if they're paying you 1, 2, 3, 4%, whatever, that's all debatable. They have to make more. It's a liability to them. It's an expense to the bank. Period. If I'm the bank and you give me $100,000 and I'm paying you 2%, then I owe you $2,000. Period. I have an expense to you. Okay, so I'm going to try to lend out your 100 for more. I'm going to try to make $5,000, $6,000, $7,000, $8,000, $10,000 on that, and I'm going to use your money to pay you back the $2,000 that I owe you. So that's how it works. And so I think that's what OPM is. So the system is designed where everybody puts their money onto the shelf. The banks, the wealth managers, Wall Street. Let's just put this whole thing. Let's put the whole category at Wall Street. So I think this is a Wall Street, Main Street issue. What we try to do on this channel is try to make you understand that you are Main Street. Most of us are Main Street. I'm certainly Main Street. Danille's Main Street. Everyone I know is Main Street. Wall Street wants your cash. And in a lot of cases, they have it in the form of savings or whatever it is, or pensions or insurance or retirement. We already went through all that. So your job is to, okay, since I already know this is the system, how do I go borrow from it? And what are the costs and the prices and all that kind of stuff? That is the way it works. So understanding how money works and understanding how the system works is as important as why you would use OPM. And then, of course, if you can, like if you're going to buy something, let's say a house is, I don't know, $500,000, and you don't have $500,000. Well, if you can borrow through debt and equity, if you can borrow the $100,000 from friends and family, and then a $400,000 from a bank, and the cost of the return from that house is significantly more than that, then you've just made everybody a bunch of money, including yourself. So that's why you don't need money, because you just need a deal. You need something that makes everyone money. And so when you find an actual deal or something that makes money, it's compelling. Now, all of a sudden, the banks want to lend against it. Investors want to invest in it. I mean, you guys have seen this. You've probably been there. You've probably seen these deals. You probably invested in some of them. And maybe you're even the one that creates those things. And so it's important to understand that the deal, you start with the deal, because that is the only thing that pays everyone back. So that's what the bank's going to look at and lend against. That's what the investor's going to invest into. And then they look at you as the team, or the team that you might have to be able to pull all that off. So you can save all you want and try to do that on your own. It's just going to be a lot slower and more methodical, and it'll take longer time. And to be honest, that's kind of what Danille does. Like, at this point, she hasn't really done OPM. I mean, she has in the form of debt.
I have it in the form of debt. Like, I've learned to leverage the bank more. And I think that's what a lot of our listeners too would relate to, is that, if you only put 10% down on a house, you really are using other people's money, the banks, for the 90%. Where on my first condo that I bought, I basically paid like 90% cash and then leveraged 10% debt. Where if I would have done it differently and bought more when homes were cheaper, my net worth would be higher now. I just didn't understand that. And so I think a lot of people, they think they need 20% down on a home or more, when really they need to be leveraging that bank loan more if they can afford to do so. And let's chat about the role of inflation in real estate, because the reason it works is because when you're leveraging other people's money or you're leveraging a bank, you also have inflation and asset inflation going on at the same time.
Right. So let's take a look at the inflation rate today, 3%. Okay. Now, we're going to make some assumptions here. Let's assume that whatever you buy today is going to be 3% more in a year, right? Okay. I mean, that's essentially what an inflation rate means, right? So now it may or may not be. It might be actually lower. It might be actually higher. But the point is, we have to use something. We have to make some kind of hypothetical. So we're gonna use 3%. If you buy a home at 3%, if you buy a home at $500,000 and the inflation rate is 3%, that means that home has inflated 3%.
$15,000.
Yeah, that's what that means.
Mm-hmm.
Okay. Now, if you've only put down 20%, of that 500 grand. Let's say you put down 100 grand. That means that you've actually borrowed the 400 grand, and that's also made 3%. So your 100 grand has made 3%, but the 400 grand that wasn't yours was also gone up 3%. So, and that's 12. So, your 100 grand went up by 3 grand, but the 400 grand that you got from a bank went up 12 grand. So this is kind of the point. And then if you do it correctly and you have a renter in there, the renter pays all the mortgage payments and the costs and everything, and hopefully you're cash flowing as well. But if it's just you, that's how that works. And so inflation drives up hard assets, right?
But then it also compounds, right? So like the next year, your place went up 15 grand, but then it exponentially goes up more because what inflates also goes up 3%.
Yeah. So next year, now you're at 515 grand.
Mm-hmm.
Right. And then it's 3% of that, which of course is more than 15 grand. Right.
Mm-hmm.
So that's what compound means. And so, now, as we know, we've seen inflation under 3, and we've seen inflation as high as 9, just in the last few years.
But asset inflation in the last 5 years has been 50%.
Correct. Right. So that's kind of the point. And so when you use OPM, you're also benefiting from the, some people will call it appreciation, but appreciation is part of that is literally inflation. But it also can be what I would call forced appreciation, which is another huge benefit. And forced appreciation means like what Danille did when she bought her first place. It needed a lot of work, right?
Yes.
So she put, I don't know, 15, 20 grand into it.
Mm-hmm.
And it was worth 40, I would call it 40. It was a double, right? She spent 20, let's say, and it was worth 40 more, right? A renovated house in that market was worth 40 more. And so she made 20 grand on her 20 grand. Mm-hmm. If she would have sold right away, which she didn't, thankfully. She held it and kept it and was renting it. And it's cash flowing like crazy. That's kind of the point. So that's called forced appreciation or forced equity. That's different than inflation. But then again, if now in her case, where that house went up 40 grand and she spent 20 grand doing it, now she's also getting 3% on that 40. So it's exponential and it's compounds.
But one of the things is that we have in the U.S. that I don't know if they have anywhere else in the world. If they do, it's not very many places, is we have true fixed 30-year debt.
Yeah.
So, that is how you benefit from the inflation. Because if you get a home for 500 grand at 6%, and then it appreciates over all this time and inflation goes up, let's just say 3% a year, even though it's been more, in 10 years, you're making 30% more income just based on, or probably more, but just based on the same exact job from that 3% increase a year, your payment is still the same. Your rents go up, over time with inflation. Your payment stays the same. And that is the main way people are getting wealthy through real estate, and why they're getting wealthy is it has a lot to do with that fixed year 30-year debt.
It's a big deal. Yeah. Like we were having dinner last night with 4 Canadians, that friends of mine that I did some deals with years ago. And they're in town playing golf. And Danille got into a fascinating conversation with one of the guys on this issue.
Yeah, because, their debt, their fixed rate debt, it's not really fixed. It resets every 5 years to the market rate, but it's considered fixed rate because you stay the same averages below or above what the debt or what the rate is, right? And so he could not believe that I told him I have a 2.6% rate on one of my properties. And he goes, yeah, but not fixed. I'm like, yeah, fixed. He's like, but not for 30 years. I'm like, yeah, fixed for 30 years. Because I was trying to explain to him why sellers aren't really in a bad spot in the US and they're not urgently selling. Where in Canada, it's a little bit different because their rates are resetting. So they're, crunched on income as well, but then their rates are resetting. So their home prices, their mortgages are going up. So it's very different. And that's a huge benefit to the US real estate market.
So think about up there, you buy something and you have a mortgage payment for 5 years. It could go up in year 6 or it could go down. But in this case, they were saying it's going up.
Yep.
So, and of course, now you're back to this wage growth and all that kind of stuff. And my friend Bruce said, well, we already know because we did a whole thing on Canada. The price of homes is in the sevens in the nation, right?
Average.
We are $300,000 less than them on their average price.
Imagine that, guys.
Yeah.
They think our price is a steal. They could not believe that you could get a starter home in the Phoenix area for $550,000.
Yeah, they about fell over in chairs last night.
But you tell people here that they're like, oh my God, that's so much money. But Canadians, that's like a steal.
I just want to remind you of one thing, Danille. What did you pay for your first house?
$230,000.
Say that again.
200.
Oh, there you are. Right. And what's that thing worth today?
Over 5.
Oh, there you go. So I got a rich one over here.
Well, but the thing is, though, is it's a real thing, like you have to take advantage of that. It's all about taking advantages of our laws and how our structure is set up. And one of the biggest things is the 30-rate fixed mortgage.
30-year.
Yeah, or 30-year.
Yeah. You're right. And I think that's something that we don't actually pat ourselves on the back from a U.S. standpoint enough.
We take it for granted.
We do, because that is not normal, guys. And so there's, well, we're always bitching when you're inside the fishbowl. You don't realize that the water you're in, right? Like so, and it's actually not so bad.
Nope. So let's talk about how real estate protects in a down market, unlike stocks or maybe even crypto. So like real estate value. So when you own real estate, the biggest thing is protecting your cash flow, right? It doesn't matter the value of the real estate. And that's hard to wrap your head around if you're not invested in real estate, because it's every buyer's biggest fear is that they buy something and then the price goes down. But at the end of the day, as long as the rent is staying close to the same and you're cash flowing, you can withhold that storm, right? Which is a lot harder in like a stock market or a crypto market when it crashes.
Well, there's a bunch of variables, I think, that you have with real estate that you don't. When you buy a stock, you think of the control you have, really. I mean, the only control you have is selling or buying, right? That's it. And with real estate, you do have more levers. I think that's the important piece, right? So if the market is becoming really competitive, then there are things on the management side that you can do to try to keep your tenant there long term, right? And to mitigate your cash flow long term, and you can kind of weather the storm. There are things that you can do on the expense side. There are things that you can do on the other income side. There are things that you can do on the occupancy side. And in the worst scenario where you have a move out, there are things that you can do temporarily to attract somebody in there to kind of hedge up whatever you might need. So you have a tremendous amount of flexibility and more control, I believe. Although you have to know how to do it, you have to understand that, and that is really literally the purpose of this channel, is that you have to understand what are the things that I can do to mitigate my risk in the future as markets change, and they will change. That is the most important thing. And I think you just don't have that. I know a lot of people that wake up in the morning and look at how a stock's done or how our Bitcoin's done, or, and we have friends that are obsessively just grind away on, the price of crypto and the price of Bitcoin and all that kind of stuff. And that's okay. But man, I would be very, very careful with having all my eggs in one basket, right? So I'm not against crypto or Bitcoin. We have some, but the point is, you need to be well diversified, and all these things are moving at different paces. But on specifically on the real estate side, I'll give you an example. As rates started to go up, this is 2022. Inflation shot up, and then the Fed started raising prices. Ross and I looked at a couple deals, and we're like, we have these loans maturing here in the next year, right? So again, things move slow. There's 2 Fed meetings in the next 60 days. There's plenty you can do now, and based on where you think might be going. So what we did is we did what was called a cash in refi, and everybody's like, "What is that?" Oh, just like a cash out refi. We actually paid money. It was a couple $100,000 is all. to actually fix our debt. And so I wanted assurance through whatever was happening next of what my payment was going to be, because it cash flowed. So as I had a floating debt on that one, I was like, okay, we better do this. And they were moving fast, so it was a cash in refi. Normally you don't buy properties for cash in refis. You usually do them for cash out refis. But in this particular case, and that point of that story is that there are things that you can do that are in your control, without selling. And there's no cash out refis happening right now, guys. Not for any time soon. And so it was, in hindsight, look, it's a brilliant move that we did. At the time, we weren't sure. We're like, oh, let's be assured of the cash flow on this property with this new debt. And then we don't have to think about it later, and we can deal with this later. But we just want to make sure it cash flows for the long period of time. And thankfully, we did that because prices continue to run, or interest rates continue to run. And the real estate market's a little bit in trouble. So that's what I mean by control.
And when you say the real estate market's in trouble, you mean multifamily?
Yeah, the values are down, and certainly income. The amount of rents are flat, and there's concessions and all that kind of stuff, and expenses are up. So right now we're working on the expense side. Again, that's within our control. We just had a huge insurance meeting last week to talk about how do we mitigate our insurance costs and still comply with the lender, and so there's things that you can do, when you have a bunch of options, and you just don't have that, in my opinion, with stocks or Bitcoin or anything like that. You're just subject to whatever's happening.
So let's also talk about building generational wealth, because real estate is a great way to build generational wealth. Part of this is the pass-through, tax-deferred way you can pass on real estate without having your kids pay taxes on it.
Yeah, there's a lot of ways here. The ones that a lot of people will just stick to those. There's the two big ones I would say are the 1031 tax-deferred exchange, which is an IRS. 1031 is actually the code on IRS, which basically says that you can roll your capital gains forward into another deal. So you just keep rolling that forward through really, you're deferring your tax. That is a really, really, really good way to do it. Another one is to set up trusts. And this is more complex, so I'm not going to get into the details of it. But essentially, there's revocable and irrevocable trusts, and you can move assets into those trusts, and they grow inside of the trust. So that is certainly another way to do that.
Yep. And so let's kind of wrap up for today. So we learned that not all debt is equal. There's good and bad debt. Other people's money let you scale without saving up forever. Inflation hurts savers, but it rewards smart buyers. That's a big one, right?
Yes.
And cash flow makes real estate resilient in downturns.
Yeah. All incredibly, an incredible list there.
Ken loves lists.
I do. Danille loves lists.
I really love them.
To-do lists every day. What are we going to do today? Let's put it on a list. Let's just schedule. I'm like, I don't want to schedule.
Well, our friend's wife has a hair washing calendar.
She has a hair washing calendar. And I said, that's crazy. She goes, I have one too. I just don't show it to you.
That is true. As you ladies know, if you only wash your hair every few days, you really got to plan out what days it's going to be clean.
I don't know about you guys, but I've never thought about this before. And
we'll see you guys next week.
All right.